We talk a great deal about funding. I would say probably 99.9% of the companies that approach the Hudson Valley Center for Innovation need money. And as we all know, funding has been an issue. Let's just call it an issue. And the current debate amongst venture capital practitioners and others in the investor community on what to make of the current boomlet in seed stage deal making has yielded some interesting insights into the past, future, and the overall health of the venture industry. The seed boom versus bubble, that discussion is a very healthy one. Again, most of our companies are considered earlier stage, emerging. Funding is critical, but as you'll hear during this presentation, there's hope. There's some new trends starting that have already begun, starting here in the Hudson Valley, which hopefully we will help catalyze into new types of thinking and investment. As in any debate over an emerging trend, one of the factors that bears close examination is whether or not the underlying issues are fleeting and cyclical, or whether they're deep and structural changes afoot that would support a wholesale shift in how industry functions. That sea change in venture capital is underway and is hardly news. Versions of this argument have been made with regularity for the last couple of years. Oh, I'm surprised this works. The venture capital community at large has passed an important milestone that may mark the end of one era and the beginning of another. This dividing line in history was revealed this summer in the latest report from the National Venture Capital Association, which showed that 10-year returns on venture capital investments had turned negative at the end of 2009 and nosedived during the first quarter of 2010. Let me translate what that might sound like insider mumbo jumbo. Venture capital, investing, the lifeblood of the innovation economy, has become a risky bet. In the game of venture capital, the 10-year return on investments is one of the closely watched benchmarks on performance. Now, everyone can have a bad year, but for the quarter ending March 2010, the return on investment to venture capital funds nationwide is a negative 3.9%. So how's the world changed? The larger problems plaguing the venture industry are really about how the world has changed since the dot-com bust. The venture industry's financial model was built on having a significant number of their portfolio companies hold initial public offerings of stock. Venture firms depend on windfalls from these IPOs to overcome failed investments and to deliver healthy returns to investors. But except for a couple of years, the IPO market has been comatose. It's literally dried up. VCs were hoping against hope that this year might finally be the year that the IPO made a comeback. But once again, that hasn't happened. According to the Renaissance Capital Group, the Bay Area has 9 venture-backed companies go public this year. That's up from 2 last year. The most notable was Tesla Motors, the electric car maker, and that represented a really, really high risk. Now, there are other companies, Facebook being one, that have pulled their IPOs. They don't need the money. So what do? So we now are faced with a new set of circumstance where IPO is not what's being touted right now. Companies are surviving on what they have, on their organic and internal growth, and it becomes a dilemma of, I won't say biblical proportions, but to the investor community, it is significant. So how gloomy is this picture? According to a venture capital survey, here we go, 90% of venture capitalists who responded expect their industry to contract through 2015. The trend is well underway. While firms have not started collapsing en masse, they have been quietly shrinking. The number of principals at U.S. venture firms fell from 8,892 in 2007 to 6,828 in 2008. As firms raise smaller funds, they need fewer people to invest. Some will argue that at least in the area of web startups, companies can be launched on the cheap, and growing numbers of angel investors, those wealthy individuals who invest at the earliest stages, are stepping in to give these companies a boost. And we have some angel investors here in the room this morning, and perhaps when we're done we can get some comment. But it's not just fewer startups. When companies don't go public, they don't generate the same number of jobs in their later stages. The cash raised from an IPO usually triggers an explosion in hiring. The real job creation starts far down the road after they go public. Instead of going public, the companies that do show potential now get gobbled up by the Googles and Facebooks of the world, and at the same time, giants like HP, Oracle, Intel, Cisco continue their acquisitions of larger tech companies, a consolidation trend that hurts job growth. So what do? There is a sea change underway. While there exists a good deal of overlap on key points behind the arguments, let me weigh in with a few bullet points that offer support for my view that the seed micro VC trend we're seeing is indeed a boom that will continue to reshape the venture industry for years to come. Angels and seed funds are more sophisticated now than ever. The current and active angel investor appears quite a bit different from what we saw during the 96 to 2000 time period. In short, fewer non-tech, high net worth individuals who made their fortunes in shopping centers or tanning salons, and more investors that came from as opposed to more investors that came from the tech world, are now getting involved in earlier stage companies. The institutionalization of seed funds means that smarter people are getting involved, more experienced, not necessarily smarter, more experienced people are getting involved in seed funds, becoming institutionalized. Therefore, the monies that are invested perhaps are being invested smarter, are being invested more cautiously, considering the risk factors, sorting out so that we don't run into the same situation now that we did during the dot-com bust. Capital efficiency. As everyone has heard, the cost to develop, build, and launch a technology startup has fallen dramatically over the past decade. This is very important, so pay attention. By some estimates, the cost to produce, design, develop, test, launch, and scale a basic e-commerce application has fallen by 50% every 2 years since 1995. This is significant and not reserved for only internet and software companies. The impact, let me move that down. The impact from a financing perspective is equally dramatic. A decade ago, it might have required $5 to $10 million in investment capital to take a company to the point that it can be today with less than 1/10 of that amount of capital. The obvious consequence is that it takes less capital to launch a startup. In many cases, it also takes less capital to sustain one, at least for this period of time. So the current trend of capital efficiency means startups get farther with less capital, negating the need for big capital raises that large established funds typically need to justify their fund. succeed or fail, quickly and cheaply. Benchmark Capital partner Andy Ratcliffe liked to say that startups needed to fail fast and cheap. His point was to emphasize that startups will make numerous mistakes in their development, but to make those mistakes quickly, as cheaply as possible, and to pivot to another approach or product or market that has a better chance of being successful. Failure's tough enough. A long, drawn-out, and expensive failure is excruciating. The emerging cachet of new seed and micro funds. One clear shift that I've seen is how there is a new crop of seed stage investment firms that are being perceived in the marketplace and, more tellingly, by the founders and management teams at promising young companies. Clearly, for many emerging companies in the broad Web 2.0 sphere, being aligned with a younger firm is being highly prized. So there's a shift going on in how they are structured as well. Many storied firms need to reevaluate, rebrand in order to be relevant in early stage. The mindset, and we know this from personal experience, the mindset of traditional venture capital has not been towards early stage, seed stage investments. The risk factors alone would scare most VCs to death. Secondly, we also know that earlier stage companies need management guidance and assistance on a continual and regular basis, which is why we exist. But that investment and that availability of talent has been few and far between. So by reshaping and reevaluating, and I'm not sure that all of the traditional VC funds can accomplish this. The mindsets are very different. The outcomes, the risk factors are very different, but the rewards and potential for significant opportunity are very dramatic. And we're not suggesting in any way, shape, or form that large venture firms won't go away. Sure, the industry is shrinking, nothing earth-shattering there, so is everything. There'll be a net reduction in the number of active venture firms, and on balance sheets, assets under management will decline. This is part of a maturing winnowing cycle that, as indicated earlier, has been going on for almost a decade. Startups usually fail quickly. Venture firms are 10-year vehicles, so things are not so brisk. Moreover, one or two well-timed exits can turn things around for a venture firm that looked doomed. Hopefully we have one of those here today. In summation, you're welcome, there are fundamental changes at work in the venture industry, which give significant and lasting advantages to seed and micro funds that can exploit this market opportunity. This boom in seed and micro VC activity is not so much a boom as it is a seismic shift in how technology companies will be founded and funded for the foreseeable future. Similarly, capital efficiency and business model innovations are not trends that will go away or be supplanted by something else. As we all know, today's technology architectures built on the past, reducing costs over time, and commoditizing things that once required huge budgets and thousands of man-hours to develop. Seed stage investors will be with us for a while, and the continued institutionalization of that segment will bring more order and structure and hopefully funding to our clients. Here within the HVCFI, we've always been strong advocates for increased access to seed funding. While much of this presentation is fueled by the venture capital industry, here in the Hudson Valley, we've not had the attention of most venture groups. Seed funding is the embryo from which our university-based and independent technologies are developed and commercialized, and now due in part to our relationship with the College of Nanoscale Science and Engineering and NYSERDA, we're taking a bold step to provide a path to clean tech commercialization. For those of you who are here, who are at the threshold, I invite you to contact us and see how we might help you grow and flourish. We remain vocal for local and regional economic development organizations, chambers of commerce, working together with HVCFI and state officials to recognize the need and impact seed funding has on our community in terms of technology-based economic development, jobs, workforce growth, and establishing our region as one of the cornerstones of growth and economic development. So that's my presentation for you this morning.